Welcome to Market Call. I'm Marella Fernandez. John Hood with us on the show today. He's portfolio manager at Croft Financial Group, and he's going to take your questions today on ETFs. Here's how to reach us. 1-855-326-6266 if you want to call in. You can email your questions for John to marketcall@bnnbloomberg.ca. John, thanks very much for coming in.
Thank you for having me again.
We have had markets in a bit of disarray this morning, we'll say, drops after the attack on Iran. We're in what seems to be the next period of uncertainty. Is that sort of a new period, the second stage of what was first tariff uncertainty and now it's geopolitical?
Well, it's the geopolitical has always underlined all of this sort of thing. And I remember speaking with a military analyst about 4 years ago, who basically said the reason that the United States had never directly attacked Iran was because of their air defense system and missiles, that they had thousands of missiles like quills on a porcupine. But in fact, the Israelis proved that was not the case a few months ago, and by lunch, they'd wiped out an awful lot of it. So this geopolitical thing is that Iran doesn't have many friends. Bashar Assad is gone. And he wasn't Shia, but he was Alawite, which is very similar to Shia. Saddam Hussein is gone. Hezbollah has been smashed. And Hamas is under attack on an ongoing basis. So Iran doesn't have many friends. So I don't think geopolitically that there's a huge risk here. So, and that's where that sits.
You think it'll be sort of a one-off?
Yeah, it's always dangerous when there's missiles going off, but I don't see this as a huge event, at least not this far. Okay. I think the U.S. is pretty dominant in this area. So
during this time of what was great uncertainty, even just a couple of months ago, how are you advising investors? What are you telling them to do?
Well, the main thing, trying to predict what Trump is doing is like you might as well play Ouija, try and guess it on a Ouija board, okay? You just don't know. Sometimes I wonder if he really knows, but nobody knows. So it's very important in markets like this that investors know what they're going to do. As I've often said on this show, I may not know what markets are going to do, but I certainly know what I'm going to do in response to different kinds of markets. And that is for investors to look, at their asset allocation, their risk tolerance, and understand what it means, and make sure that, A, you've got good quality assets, so that if markets decline, you can be reasonably confident they will come back. And if markets decline, it gives you a great opportunity to buy more. The last thing you want to be doing is buying into a market that's at its highs because of a fear of missing out, or panicking and selling when markets are down. That's the old buy high, sell low, which is exactly the opposite of what you want. But people need to have an understanding of how they will react. What strategy will they have if the market drops 5%? For me, if it drops 5%, I ignore it. If it drops 10%, I start paying attention. 15%, I start adding equities back in. And 20%, I add another 5%. So it's a little formula that I use, and it's worked out pretty well.
All right, so stick to your strategy once you
stick to your strategy,
yeah.
Just understand what your strategy is, first of all.
Got it. Okay, we're going to take a quick break, line up some phone calls and emails for John Hood. He's of Croft Financial Group, taking your questions today on ETFs. Back in a moment. Welcome back. John Hood with us today as our guest. We're going to start with an email. Lauren says, I wondered if you had an opinion about the gold ETF, HGY. Let's pull up that chart if we have it and take a look at how gold is doing today. I imagine it's up considering what's going on.
Yes, it's up considerably today. The only thing I find with, if you're writing calls on something that is high volatility, like commodities or some of the Magnificent Seven stocks, something like that, I tend not to do it. When I'm writing covered calls, what I really want is dividend pairs, a more conservative approach, and writing calls on them rather than commodities, because I find that if you write them on something that's volatile, you're severely limiting your upside potential.
Okay.
But you're not protecting yourself that much on the downside. You're not getting much income relative to the risk. So I prefer to do it with dividend pairs. On the other hand, for real options traders, they like doing that because the premiums on the options are so rich. Okay. But for my investors, that's not what I want. I want something more conservative. I'd write it against bank stocks, against dividend pairs, utilities, whatever, without the commodity basis. So I wouldn't be buying this for my clients. There's nothing wrong with it, as long as you understand that you're going to be giving up a lot of upside when you sell calls against it, because that's the trade-off. If you sell calls, you get income, but you limit your upside.
Got it. Okay, let's do another email. This one from David. Is this a good ETF for Tesla, TSLY? Is the payout sustainable, or is there a better option you would suggest? So they're interested specifically in Tesla, but ETF-wise.
Yeah, this is a new thing that's come out lately where it's a single stock ETF, and then you write options on it. And for the same reason, I wouldn't be doing this for my clients because, first of all, there's no diversification in that. I like selling calls against ETFs. Not interested at all in selling them against a single stock. These have become quite popular this year.
Is there a benefit to that?
Well, there is, because you collect the premium from the options, but you don't, which can be very good. But again, it's not something that I want to do. This is for people who want a little bit more risk going on in their account.
Okay. And are people interested in doing that more with tech stock? They're seeing more of these ETFs that are just based on one tech stock?
There's quite a few of them, yes.
Yeah. Okay.
Yeah. So but it's not for my clients.
Got it. Not something you would do. All right, let's go to the phone line. Sam is on the line with a question today from Toronto. Hi, Sam.
Hi, I'd just like to know your opinion about silver future. It doesn't go up, and how about the ETF SVR? I would appreciate your opinion. Thank you.
Okay, so the iShares Silver Bullion ETF, let's start there.
Yeah, I have no problem with that at all. A lot of people like silver because it's a little less priced than gold. If people want to be in that market, that's a perfectly good way to play it.
What do you like about it?
Well, it's just that it's based on bullion rather than silver mining companies per se.
Which is more risky?
It's a little bit more risky. Well, it depends on the mining company.
Sure.
But if you were Barrick and all of your mines have been closed in Mali because the government's taken over and the French Foreign Legion has been chased out by Al Qaeda, then
yeah,
it's a different
not a good
story.
place to be.
So it's. But I think if you want to be in that market, that's a perfectly good way to do it. iShares is behind it. It's not some little outfit. So if I was buying silver, I would probably go that route.
Got it. Okay, let's go back to an email from Sandy. I want to get into Bitcoin through an ETF. Is there one you would recommend? Where do you land on Bitcoin? Okay.
Whenever I look at Bitcoin, I immediately start running for the exits. The risk on this is just too high as far as I'm concerned. It's a real factor in terms of markets and currencies, et cetera. But there are too many issues in that. And a number of Bitcoin people like Bankman-Fried, example, they blew up. A number of these Bitcoin providers, et cetera, have blown up. So I'm not interested in putting my clients in that. If, on the other hand, I did, and what happens sometimes is, for example, recently I had one of my clients ask me to buy him some Bitcoin. Well, it's the client's money, not mine. And if he really wants to do that, then I will facilitate that for him. So the one that I recommended was iBit, which is an iShares product. Again, you're dealing with iShares. It's a highly reputable company. Second or third largest money manager in the world. So if I'm going to do anything on Bitcoin, I'll do it to them.
Okay, so specifically under an iShares banner here, is there any other one you like?
Not really. No, I just stick with that. And I'm truthfully not all that familiar with that market because I have no real interest in it because, again, I'm in the investment business, not the gambling business.
Got it. So. Okay, too risky. Let's go to another email from Dave. He says, can your guest comment on holding ZMMK instead of money in investing savings account? ZMMK, can you tell us a little bit about it?
Sure, that is the Bank of Montreal money market account. So it's got banker's acceptance paper, it's got government bonds, it's corporate bonds, et cetera, et cetera. So it's a good vehicle for fixed income, very good vehicle. And I prefer that over investing in a high-interest savings account, HISAs as they're called, because there's more diversification. Some of these HISAs, you don't have the protection of the $100,000, and some people think that you do. But again, this one is something that I would have no hesitation recommending to clients because it is diversified. I tend to be more right now in short-term T-bills, but if we were in a slightly different market, I would certainly be looking at that one.
I guess if people want to put their money and they want it to stay safe, then you can put it aside and it'll sit there in your savings account, not do much. Is ETF, slightly riskier, something like this? You do have more of the hills and valleys.
Well, you've got better diversification in it than just a single bank. If we look back during the financial crisis, one of our major banks, who shall remain nameless, was in very great trouble and could have easily gone under. And what happens to your depositors at that point? Sure, a lot of that is protected, but that was the reason that Jim Flaherty, as finance minister, stepped up with $35 billion, was so that one of those banks would not fail. So these are the reasons that you want diversification on your savings and deposits.
Got it. All right, we're going to take a quick break. John Hood with us of Croft Financial Group. He's taking your questions today on ETFs. We're back in a moment. Welcome back to Market Call. Thanks very much for joining us. John Hood is with us today to answer your questions. We're going to an email from Carl. Carl says, what do you think about UMAX to provide a dividend income? Is it a safe investment? Can you tell me a little bit about UMAX?
Actually, I'm very glad that the viewer called about this product as well as similar products. This thing advertises a 15 to 16% yield. So we have to ask ourselves, how come? Mm-hmm. If T-bills are paying 2.5%, why is this thing able to pay 15? And so the first clue, whenever you see a really outside yield, you have to say there's something going on here that I'm not aware of. So first step, take a look at the performance of the stock since the IPO was issued, which is 2 years ago. And it's dropped appreciably since that time. And that's not just because of market conditions. Markets have been going up. So why has this thing dropped? The reason is when you're looking at your returns on investments, the return on your capital, we want to know how much money we're making on our money. Mm-hmm. But there's a different kind of ROC, and that's the return of capital. And this is the kind of thing that was very common with income trusts, split bank core, all kinds of stuff like this. That in this particular one, I was looking at this actually recently, and their distribution yield was about $2 a share or something like that. But on their own website, they say that about 1.6% of that is the return of capital. In other words, they're giving you back your own money and calling that the yield. Well, no, I wouldn't touch that. Wouldn't touch it because you're only ending up with about, if you combine on a total return basis, the sharp decline in the stock price, plus the fact that you're getting the distributions, 3/4 of it's your own money. No, I won't touch it. So whenever you're looking at something like this with an outside yield, there can be a number of reasons for it. One of which is a number of ETF providers will leverage their position. So they will have, instead of 100% invested, they'll have 125%, there'll be leverage. I don't like leverage. I don't use anything with leverage. Or it can be a longer term bond, which you don't want these days. Or it can be something where there's a greater credit default risk on the bond that gives you a higher yield. Junk bonds, in other words. I won't touch any of that stuff. I like a good mix of AA corporates and government and anything I'm doing in fixed income because, you don't want this stuff defaulting and going belly up. That's one of the reasons I don't buy GICs. You hear a bunch of trust companies you've never heard of, and they're issuing GICs. No thanks.
Got it. Okay, let's go to the phone lines there. Nazar's on the line from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Marilla. Hi, John. John, may I have your thoughts on ZST, please? This is the BMO Ultra Short Bond ETF.
Hi. I'd be glad to. ZST is something that I've held many times over the years. It's a very good short-term bond index from Bank of Montreal. It's a good mix of bonds. Again, right now I don't have any, but I certainly have in the past, and I wouldn't hesitate to buy it again.
Okay, so it's at 49.02, down a little bit today, the ZST, and you said you wouldn't hesitate to buy it again. It's short-term bonds, meaning how long?
Oh, they 6 months a year, okay. And then you get into midterms and all this. Right now, I want everything as short term as I can get, and that's why I'm doing T-bills.
Got it. Okay, let's go back to the phone lines. Frank is on the line today. He's calling from Waterloo, Ontario, with this question. Hi, Frank.
Hello there. Good afternoon. Just want to get Mr. Hood's opinion on HMAX, and is it an investment or is it a trade? Thanks a lot.
Okay, thank you for the question.
Yeah, hi, Frank. Again, in view of the previous question before was on UMAX, is that it's from Hamilton ETFs, good company, but you've got to take a close look at what the dividends look like in their yield relative to, say, the banks at 4%. What are they talking about in terms of the yield on this stuff? And if it's outside, there's something about it that you don't quite know. Now, it could be covered calls, which I'm all in favor of on banks and dividend pairs, but there could be something else in there, including leverage, et cetera. These are the things you've got to take a look at before you go ahead.
Okay, so a couple of things to check out before moving on that. Okay, let's go to another phone call. We have, an email from Tanner. Thoughts, he says, on XEQT as sole long-term hold in my TFSA. Are you familiar with XEQT?
I'm not sure if that is bonds or that's an equity.
Let me pull that up and see what.
Or is it equal weight? What do they have to say there?
Equity there. iShares Core Equity.
Yeah, I'd have no problem with that.
iShares generally, it sounds like you are comfortable with?
Oh, very comfortable with iShares, Vanguard, Bank of Montreal, Global X, a number of them. But when you get into a number of the smaller ones, it gets very niche-y, and that really isn't of interest to me.
Okay, so if you are checking or interested in one of the smaller ones, not a well-known name, can you just go through what you should look for, like to really know and understand what you're getting into?
Well, first of all, you need to take a look at what is an ETF and what does it actually do. The other thing is, if you're looking at, for example, there are in the U.S., I think there's several thousand ETFs. When I started, there was one ETF in Canada and one ETF provider, the XIU. Now there's over 50 providers and 1,500 ETFs.
Why do you think they've become so popular?
I'm sorry?
Why do you think they've become so popular?
Cost. The first reason is cost. They are so much cheaper than mutual funds, which, when I first came on the show 15 years ago, mutual funds were all about 2.5% annually. ETFs were coming around 30 basis points. Huge difference. So that is what has driven the investors from mutual funds going into ETFs. Primarily cost. Liquidity is another big factor. Because ETFs, just by nature of their structure, are very, very liquid. Most of them are, until you get into some of the niche ones where they may have a lot of small caps, which are not so easy to get rid of. But it was really driven by cost. And then, of course, Vanguard came here. And that got even the Canadian ETF providers to squish their prices down even more, because Vanguard is very good at that. They're very low fees. So, but that's what it was basically, people were getting tired of these deferred sales charges, and it's taking years to get rid of these things. But it's the way that mutual funds were sold. And people would, the planner or whatever, would get 5% up front. Well, the fund company had to get their money back, so they upped their fees to 2.5%. Now the banks are in the business, but their fees are running around 2%, still way above an ETF. I can buy an ETF on the S&P 500 for 3 basis points.
Yeah.
It's free, not 250.
Got it. Okay, we're going to take a quick break. We're going to go through some of John's past picks when we come back. Time now to take a look at John's past picks. These are from June 25th of last year, so just under a year ago. At the time, John picked TD US Equity Index ETF, TPU, on the TSX. It was $42.24 at the time. It's moved to $46.61 a return of 10% upside and total return of 12% upside. Tell me what you like about this ETF and what's in it.
Okay. This is from TD Bank. TD has been in and out of the ETF business for some time. They came in it fairly quickly, but then left and have come back in again a couple of times. TPU is their S&P 500. So it's basically the same as XSP from iShares or from BMO BSP, or Vanguard BSP, all the same stuff. The only reason I bought this is because in cash accounts, is that if I wanted to add, and I had sold off my bank shares, and I didn't want to get back into fixed income. I wanted more U.S. equity. This was a good way to do it. But when I bought TPU instead of adding to XSP, if I bought XSP, it would have consolidated for CRA purposes the lower price, higher tax when I sold it. So I bought TPU. I don't like to have a whole bunch of different ETFs that are all the same but just different letters at the front, right? But this was done for a reason, which was to say tax. So,
okay.
But it's S&P 500, it's TD Bank, nothing wrong, perfectly good.
Got it. Okay, let's get to your next top pick from last June, Industrial Select, so XLI in New York, 122 when you recommended it a year ago in American dollars. Up to 143.16, so a 17% upside, and then a 19% total return. Tell me about this ETF.
Okay. The reason for buying this, because this is an industrial, it's a SPDR ETF, State Street. So this was on U.S. industrials. But my specific reason for buying this is because 25% of that ETF is U.S. defense stocks. And in my view at the time, and certainly these days, that's where you want to be.
So let me ask you, because I was looking this one up, and it also has Uber and Caterpillar, I believe, in it. So it's part defense stock and part...
Oh, yeah, and a whole bunch of other stuff, yeah.
Okay.
But my reason for buying was the defense sector, and that's 25%, which is... And really, the other defense ETFs often were overweight Boeing. Well, I don't want to be in Boeing, and other airliners, Airbus, et cetera.
Do a lot of the defense ETFs tend to have the airlines
Yes.
in the mix?
Yes, a lot of them do, XAR from iShares, et cetera. But as you'll see when we get into top picks, I found one that doesn't.
Got it. Okay, so we will stay tuned for that. Let's get to your last top pick from June of last year, which was Global X03 month T-bill ETF. So this was Government of Canada Treasury bills.
Yeah, and so all I was doing there is just putting it into something safe, and I like C-bill because it is, T-bills. It's just a place to park cash.
And it's gone down a little bit, not significantly.
Yeah, very little.
But you would stay in this at this point?
Oh, yeah, I'm in it. Yeah, heavily in it. Yeah.
And tell me what you like about it moving forward.
Again, it's the same place I'm parking money on a short-term basis. Well, I don't have any risk there.
Got it. Okay, we're going to take a quick break. John's going to stick around to take more of your questions on ETFs. We're back in a moment. Welcome back. Thanks for joining us today. Let's go to an email from Charlie from Montreal. Sorry, it's a phone call. Charlie from Montreal on the line. Hi, Charlie.
Hi. Thank you for taking my call. I'm calling today about HXT. It's the Global X tracking the TSX 60. I'm using a non-registered account, so I thought this might be more tax efficient, being that it has no dividends and it only gives a capital gain. I just want to know, does this still make sense even though it has a higher management fee? Thank you.
Okay, thank you for the question, Charlie.
Okay, Charlie. First of all, Horizons, for quite some time, was competing with iShares, BMO, Vanguard, et cetera. But then they were taken over by a Korean firm, Mirai Asset Management. And Mirai was very big through ETFs through it was called Global X, which they own. So the horizons have now all become Global X.
Got it.
But this is basically the TSX composite, or the TX, maybe it's the top. If it's based on the XIU, it's the top 60.
Yes.
But in any other case, there's absolutely nothing wrong with it, and as a representation of the TSX in total. So,
Okay, and he was saying he's got it in a tax-free savings account.
Yeah.
Is that the best way to play it? He said it was not dividend producing.
Well, it's the dividends on these things are not that great. They're certainly better than the U.S. stuff. But in terms of dividend growth, yeah, sure, nothing wrong with it. Don't expect miracles.
Got it. Okay, let's go back to the phone lines. We have Chris on the line today from Calgary. Hi, Chris.
Good morning, John. My question is with regard to the Mulvihill Canadian Bank ETF, CBNK on Toronto. Look for your comments. Thank you.
Okay, thank you for the question. So CBNK.
Yeah. Hi, Chris. What I'm looking at Mulvihill products, and then I see the word enhanced. Whenever I see the word enhanced yield, that means to me covered calls. Nothing wrong with that. I like covered calls. But what I want to know at Mulvihill, and because I don't know this one specifically, but you should take a look and see if there's any leverage here, because quite often it'll be 25% leverage.
Okay.
I'm not a fan of leverage and in anything. So if it is involving leverage, if it was just a straight covered call, fine. But if it's got leverage in it or any other funny little things like that, then I'm not interested.
Okay. And again, if they're looking into that, how do they find out if it's leverage?
Phone them.
You have to phone them.
Yeah, just phone them or just go on their website and see if it's leverage. They're usually pretty candid about, all these companies are fairly candid about their leverage and what they're doing. And I'm sure Mulvihill will be happy to answer their questions.
It might seem obvious, but why don't you like the leverage companies?
Because of the risk factor. Okay. Like right now, there is a new Toronto listing, which is 3.5 times to TSX. And what can happen, these things are meant for day traders, okay? Sometimes people will buy these things that are like 2 times or whatever, and they're holding them for months and they're wondering why they're losing money. Well, it's the way that they trade on an intraday basis that you can really you could be on the right side of the market and be losing money, okay? Because of the way these things settle at the end of the day, 2 times one day, then the market goes up or goes down, and it's 2 times that, and you can get clobbered on this stuff. So on anything with leverage, I mean, most of them, if they're doing like 25% leverage, that's not bad. And if you're willing to accept the risk of that, then they're fine. But, make sure that you know that's what you're doing, that you know that it's leveraged, and there are greater risks with that.
That's what I was going to ask you. Is there any amount of leverage you would accept?
In some accounts, well, not that I would buy, no, never.
But if somebody was looking into something that was leveraged?
If they wanted it and it was a client and they said, well, let's buy some of this, then I would buy it for them, I'd pick something. But it's not something, well, I've never done it in 25 years, so it's not something
that you would do yourself.
that I really look forward to, no.
Got it. Okay, let's go back to the phone lines. Joe is on the line today. Hi, Joe.
Hi, I want to ask John about the BMO covered call bank ETF ZWB. John, with the political situation, the economy, possible situation, I have this in my cash account. I'm retired. Would it better stay here? Would I take the unhedged version to get more growth? What's your outlook for the Canadian banks in the medium term?
Okay, so ZWB, a lot to unpack here there. 2020. A little down today. This is the BMO covered call. Do you like the covered call option here?
Yeah, I do. And BMO, that ZWB is something that I have literally held for years in all of my accounts, including personals. But I got rid of it last November, December when this stuff came out about TD and the money laundering, because my concern was that there could have been a contagion among other banks. And my question was, okay, is there something about Canadian banks operating in the U.S. that there's intrinsically something about their policies and procedures that
does not align with the U.S. regulation.
Yeah, and so turns out that wasn't the case. This was just simple criminality of a very low level that resulted in a $3 billion fine. But I would be quite willing to go back into ZWB again. The only question I have on this sort of thing is, if the SEC charges TD $3 billion, why are the shareholders paying it? They didn't do it. Why aren't some of the people going to jail who did do it, who looked the other way? Because it's not the bank that's losing money, it's the shareholders.
Yeah.
And that's what bothers me about these monster settlements.
He also had a question about generally banks moving forward, financial institutions, as we move through a year of Donald Trump, a first year of Donald Trump in office, and banks putting aside more money for credit loss, considering they're concerned about a downturn.
Well, and that's true, and it's a wise thing for them to do. The other thing is, of course, we could find that Trump increases the withholding tax from 15 to 30% or more, depending upon his, whatever animal spirits are motivating him on a particular day. So it's everything is up in the air on this stuff. I mean, there's also ZWK, which is on U.S. banks. And what we forget, of course, is that unlike in Canada with basically 6 banks, is in the U.S. there's 4,500. Okay, and that's why there was a fiasco with Silicon Valley Bank, which nobody here had heard of. But that was patched up because they quickly ran in and looked after the depositors there. But it's a much more complicated thing. They're regulated by the state, but not by the SEC in the same way that it would be here. So.
But generally speaking, you feel okay or good about the Canadian banks moving forward? You're not worried about
I'm okay with that. I think the Canadian banks should do fine, despite credit loss and all of this. There's risk on everything you do. Banks generally in Canada are well managed. I know Richard Croft, Croft Financial. He was on here a couple of weeks ago, and he was very positive on the banks as well. So.
Got it. Okay, we're going to take a quick break. John is sticking around to answer more of your questions when we come back. Welcome back to Market Call. Thanks very much for joining us. Let's go to the phone lines. Greg is on the line today from Winnipeg. He's got a question for John on ETFs. Hi, Greg.
Hi, thanks for taking my call. My question is, John had mentioned earlier in the show about mutual funds a number of years back, and I know the mutual funds used to have a combination of stocks and fixed income. Now, is there such a thing as an ETF that has both stock and fixed income, or do you have to do it sort of separately?
All right. Is there something that matches both of those?
Well, no. I would be inclined to go with an equity plus a bond ETF, fixed income ETF, rather than a combination. They do have some of those kinds of things, and target ETFs and asset allocation ETFs. There are ETFs like that. I don't use them because I don't like the way sometimes they are changing the asset allocation. I want to be in charge of that, okay, of how much should be in equities and how much in fixed income. I control that. I don't want somebody else handling that for me.
I mean, I don't know if they change them continuously. Is it something that they change?
It's an ongoing thing. They would probably do on a quarterly or half-yearly basis, something like that.
Got it.
But I generally don't like them. In terms of ETFs versus mutual funds, one very important thing to recall is that, I could talk about this for the next 3 days, is that in summary, I have all of my portfolios have ETFs and always have had ETFs since I started the company in the year 2000. I have never purchased a single mutual fund in that period of time. Okay, not one. Everything else is ETFs or a few individual stocks. The problem with, there's a study called SPIVA, S&P indexing versus active management. And this study year after year after year demonstrates, it's based on the US, that index-based investing, which is ETFs, outperforms active management mutual funds 80%. 80% of them outperform the mutual fund.
And do they greatly outperform, or are they fairly close?
Fairly close, but it's, there is a huge factor in terms of fees, because if you were charging now, say 2%, the S&P average is 9% a year, going back 30 or 40 years. Mm-hmm. So if you're charging 2.5% of 3, that's a huge bite out of your earnings 20 years down the road. It's a third of your portfolio, and up to 40% of it is gobbled up in fees. So that's the reason I like ETF. Is again, if I can buy the S&P 500 for 3 basis points or 5 basis points rather than an ETF, that's what I'll do.
Okay, let's go to an email then from Jeremy. Jeremy says, another guest on the show recommended CI Tech Giants covered call ETF.
Yes.
Would you consider this a buy over others in the space? Can you first just tell us about the tech giants? Is it sort of the ones we expect, the big guys, the NVIDIAs and Teslas and Amazons?
Yeah, I don't know if there'd be, and who was that from again?
That was an
from
email.
CI, yeah. I'm just wondering again if there's a leverage play in there, or is it just based, I think actually I don't think there is, I think it's just a straight covered call on the techs. Again, it depends on your risk tolerance. I don't like that one because, these are volatile stocks. So I want to get the full value. If I'm going to take on the risk of owning some very highly priced stocks, I want the full value of the upside. I don't want it capped by the covered calls. The covered call premiums are very rich, no question. But that's not what I want for my clients. I want covered calls on dividend pairs, and everything else pretty much. I have a huge amount of the S&P 500, and I don't have any covered calls on them. I don't want them on them.
Do you like the tech ETFs generally?
Oh, sure, because they've driven 30% of the gains in the market. So, of course, yeah, absolutely, I like them, and because they have contributed so much to value. But it's also they're very high evaluations. At the same time, a lot of these things like AI, that's going to be coming through everything. I was at my vet's last week again. We were talking about the dog, and he had everything recorded. And at the end of the day, he doesn't have to make notes. But what he scribbled down while he's talking to us, AI presents it all in a specific form for vets. Boom, done.
Yeah.
And, I was... So if the vets have got it, I think it's going to be pretty widespread.
Got it. Okay, let's go back to another email. This one's from Richard. He says, I'd like your guest's opinion on iShares short treasury bond ETF as a place to park American money versus money market funds. Yeah. So that's an iShares.
Yeah, sure. And there's nothing wrong with that, with parking money in the U.S. dollars and buying treasury bonds. I like that. There's also SGov and a few others that are in U.S. dollars that I have as well. I don't particularly have that one, but I do have a bunch. So nothing wrong with it at all.
Okay, we'll move on to one more email then. Carla says, is investing in bank ETFs like ZEB better than just outright buying the Canadian banks? And I'm going to put that on a wider level. Why buy the ETF versus buying the actual stock if you are interested in a specific company? We mentioned for tech, for example, if a bunch of them are in a bundle, that's a bonus that you might be interested in. But for something like a bank, does the same rule apply? Yeah, very much. Again, it's about diversification. If you had ZEB, which is an equal weight bank, okay, from Bank of Montreal, and then you had this fiasco like happened at TD, at least you've got some protection as opposed to if you just bought TD or one of the other banks. The impact is spread out and diversified. So that's the reason, is the diversification that ETFs provide. So ETFs are generally less risky because of the diversification, except in certain situations. So how would you warn sort of the average investor or direct them those certain situations, what else they need to know, and how do they do it? Well, basically, again, you have to take a look at what the ETF is actually doing. And the leverage is one thing. The leveraging is the one thing. Liquidity is another. For example, a lot of times a small cap manager will do, like I'm thinking of ARC funds in the U.S., is that a small cap manager will do very well managing a small amount of money, but once they do well and it's known, they get flooded with money and they don't know what to do. So these are the kinds of, whoops, I think I've just gone dead. No, you've got your mic, so we're still good. Okay, is that, they don't know what to do with that kind of money, and of course the funds go flat. So, and you also have to take a look, is it a very niche-y type of ETF? Like you can buy ETFs for specific diseases in the United States, and all kinds of odd things that
makes no sense to me. So if I'm looking at broader base, I look at normally I'm looking at the 10 sectors of the spider, industrials and consumer durables and healthcare and all these kinds of major market things, some of which I think have been beaten down too much and I'll buy. Or I'll look at other sectors, like one of the things we're going to be talking about that's a little different. But again, I like buying companies that are big leaders in their field. So.
Got it. Okay, we're going to take a quick break. We're going to have new picks from John when we come back. Time now to share some new top picks from John Hood. He joins us here. His first pick is Global X Defense Tech ETF. And this is, in the name, it's defense tech, which you like right now, and I think generally is going to be on the upswing.
Yeah, it's the defense techs, as we discussed, I've looked at a number of them over the past year or so. This one I like from Global X because it's no airliners, it's strictly weapons. And they have not only U.S., but also European companies.
So it's international.
International.
Yep.
They have Germany's Rheinmetall, which makes Leopard tanks, BAS Systems from the U.S. that makes artillery. They've got Leonardo, which does stuff from Italy. Of course, it's from Italy. They do Navy stuff and guidance systems, all this kind of stuff. And there's a bunch of others. In the U.S., they have all the big ones: General Dynamics, Lockheed Martin. General Dynamics makes all of these Stingers and Javelin missiles, Javelins for tanks, Stingers for missiles, plus Patriot systems for and then you've got a whole bunch of others, RTX in there. So it's a very, very good mix of defense weapons contractors, and that's what I like about it.
When did you start looking into defense ETFs?
Because my background is in defense policy.
Got it.
Okay, academically. So it's something I'm always attuned to. I always receive information, daily stuff, for example, from the Institute for the Study of War in Washington. I subscribe to Foreign Affairs magazine. I'm a member of the Royal Canadian Military Institute. So these are things that I'm always attuned to.
Got it. Okay, let's go to your next pick, which is a Vanguard DIVD Appreciation or Vanguard Dividend Appreciation Index Fund. Tell me about this particular dividend fund.
Okay, this one, VGG, is basically the VIG that trades in the U.S. And what it's looking for is stocks within the S&P 500 that are always increasing their dividend. So there's about 300 of them. I like that because it doesn't have all of the really high tech stock. It has Microsoft, but that's trading more like a utility these days. So you're getting stocks that are not so pricey. It's a more conservative way of being in the S&P 500, but only in the S&P 300 and away from the very high valuations. So I've been buying that of late rather than the S&P 500 itself. I want something that gives a little bit more value-oriented than the straight S&P growth story, because I have lots of that already. I don't need more.
You do a lot of ETFs. If you're looking at an equity, what makes you buy into an equity?
What ETFs do I buy today?
No, ETFs compared to just a stock. What stocks do you buy straight out compared to an ETF?
None.
None at all?
No. ETFs I use because of their diversification and their low fees. And that's because, a lot of people look at the markets in terms of going over the minutia of an annual report. That would drive me crazy. They're always looking at bottom up. I look at things from a strategic point of view, top down, which components do what. So that's why I like ETFs.
Got it. Okay, let's get to your third one, which is a new topic, BMO's U.S. High Dividend Covered Calls Units ETF. This is through BMO, and it is a covered call. Tell me why you went with this one.
Well, for one thing, it's not leveraged. That's a big thing. Also, it's I've had this thing many times. I like it. It pays around 6.5%, something like that. Because it's on U.S. stocks primarily, the dividends are quite small. So most of the premium that you're getting is from the covered calls, which are capital gains. Okay, so it's got a very good yield. And the stocks, and they're all the big guys like Procter & Gamble and Home Depot and all the ones that we already know. And so that's one of the reasons I like this.
It's dropped off, obviously, in the big drop off in April,
Yeah.
and hasn't really come back. Why would you say that is?
Yeah, it hasn't come back because it doesn't have all the super inflated
The tech stock,
tech
for
stocks.
example.
Yeah, like in the Shield ETF that we were talking about, Palantir is in that in the U.S. Palantir's price earnings ratios are nuts. Okay, but Palantir has lots of U.S. government Defense Department contracts for applying AI to the military. One of the guys who was the founder of that company, of Palantir, is a guy named Paul Thiel, and he was one of Musk's partners in PayPal. Right. So this guy has got lots of contracts. They're getting lots of contracts, and that's what's pushed up the multiple. I waited actually to buy that ETF. I wasn't happy with the percentage that it took overall. But then when April came, I grabbed it because it dropped 20%.
We've got to leave it there, John. I'm out of time with you, sir, but thanks for your time today.
Thank you very
that.
much. Good fun.
John Hood joining us today, and thank you for joining us this Friday on Market Call. We'll see you again on Monday.